Good afternoon, ladies and gentlemen. My name is Martha Hancock, and I am the newly installed Chief Growth Officer at Mantle 314, one of Canada's leading climate consultancies. It's my pleasure to be your host for today's webinar, Climate Trends and Finance, What Organizations Need to Know Today. Before I introduce my colleagues, there are a few housekeeping items to cover. We welcome your questions and comments throughout today's presentation, but request that you use the Q&A box to submit those, rather than the chat function. The Q&A button is located on the bar at the bottom of your screen. And for technical issues, please do use the chat function, which is also located on the bar at the bottom of your screen. A number of you took us up on the offer to submit questions in advance when you registered, and we have attempted to ensure that you get answers as we go along. In some cases, we'll be using your questions to kick off our Q&A portions, which will be scattered throughout the presentation. Questions submitted during the webinar will be routed to me, and I will pose them to our experts for you. We will do our best to answer as many as we can as time allows. This webinar is being recorded, and we will be sending you a copy of the recording and of the PowerPoint. And I know this question comes up often with webinars, so rest assured you will be receiving the PowerPoint, and believe me, it's worth it. It is my goal to try and keep us on track and ensure that we finish up before 3 p.m. Eastern Standard Time. And now, without further ado, it's my pleasure to introduce my colleagues, and my apologies for the siren in the background. This is Toronto, just comes with the territory. Okay, I am delighted to introduce Jeff Horlor, who is an advisor at Mantle 314. He works with our financial services clients on climate risk and opportunities. Before joining Mantle 314, Jeff spent the last several years working for UK-based Responsible Investor, a leading news publication covering sustainable finance and investing. Jeff is currently working remotely from Sweden. Lucky him. So good evening, Jeff. I know it's about 8 p.m. your time.
Good evening, good afternoon, good morning to everyone. Thanks for joining us today.
Wonderful. And now I'd like to introduce my second colleague, Kevin Quinlan, who is a senior advisor at Mantle 314. He works with public and private sector clients on climate risk issues. He's a recent arrival to Toronto after having spent 10 years working for the previous mayor of Vancouver, Gregory Robertson, including as chief of staff. Good afternoon, Kevin.
Good afternoon, Martha. Good to be here, and thanks everyone for joining today.
Wonderful. Now, for today's agenda, we are going to be covering a lot of territory, as this is a fast-moving space, as I'm sure many of you know. Jeff will kick us off with an overview on the latest in climate risk and global financial stability. Next, we'll be looking at the regulatory climate, what policies are being enacted, and what policy signals are being sent right now. Finally, we'll be spending a significant amount of time looking at various market actors and how they are responding. So there are 3 Q&A opportunities for discussion during this webinar, and as you see on the slide, please feel free to submit questions as you feel moved to do so. Jeff, over to you.
Thanks very much, Martha. So like Martha said, we're going to kick today off with a bit about climate risk and financial stability. So ever since Mark Carney's Breaking the Tragedy of the Horizon speech at Lloyd's London, we've seen an increasing awareness and research into the physical risks of climate change, such as heat waves, droughts, floods, and other climatic hazards, and the transition to a low-carbon economy, how the transition to the low-carbon economy can result in significant shocks to the global financial system. So right here, we've recently seen the IMF dedicate a chapter of their 2020 Global Financial Stability Report to the physical climate risks of climate change and global equity prices. The diagram on the page is from the IMF and tries to really illustrate how financial market actors, such as insurers, asset managers, banks, which you'll see in the middle at the bottom, are impacted by current and future physical climate hazards in present time. In their research, the IMF found that global equity prices do not currently reflect the physical risk from climate change, leading to significant sudden drops in asset values when these risks become priced in the future. The report urges regulators to stress test their large financial institutions and says that the market needs mandatory climate-related disclosures to ensure that granular information is available. These are pretty well recognized needs, so the IMF really in this case is just pushing for the pace of this to pick up and this webinar will continue to look at what's happening around that. To quickly touch on two other reports we've seen come out, one was by the European Systemic Risk Board, which concluded that climate change impacting the financial system is inevitable, either through the physical impacts of doing nothing or through the cost to abruptly transition the economy. For transition risks, the report finds that while European banks' overall exposures to high-emitting sectors is limited at this time, there is significant tail risks, and that's from sort of concentrated exposures from a handful of firms to these high-emitting sectors. And that's similar to other financial crises that we've seen, where even though maybe en masse, it's not distributed, as long as some banks hold a lot of these risks, there's potential to have tail risks across. The other report's by Finance Watch, which says that the focus on transition and physical risks has overlooked the key risks, which has been highlighted during this pandemic, and that's disruption risk. The author says that the second round effects of climate change, which will impact societies such as mass migration, conflict, will be the big financial stability risk here. The report urges financial regulators to immediately change the risk ratings of the fossil fuel linked assets held by large banks and insurers to ensure they have enough cash on their balance sheet to cover these impacts. So, I mean, what we've seen is climate change has direct comparisons to the current pandemic that we're experiencing, and they're both global risk management crises. So I'm going to hand it over to Kevin to get us started on how regulators have been responding in recent months to this. Thanks.
Thanks, Jeff. We've got a lot to cover in this section, and I'm going to start with an area we're seeing plenty of research coming out on, and that's the issue of climate scenarios and stress testing from central banks. So there have been several reports released this year by an organization called the Network for Greening the Financial System, or the NGFS. It's a collaboration of 69 central banks and regulators who share best practices on climate and financial risk. I'm not going into details of all these reports. There's quite a lot to cover. But the thing to know is the NGFS is one of the leading voices globally making the case that climate change is relevant to the mandate of central banks, and that they're best placed to lead the research into how climate can impact the broader economy. And one of the big recommendations we keep seeing in all this related to central banks is that there's really a need to keep modeling around climate, keep researching, and keeping a focus on climate risk. The NGFS is really the global research hub for central banks on climate risks. And the reason I bring this up is the reports are worth paying attention to because they're clearly informing the approaches being taken by different central banks when it comes to climate change. So they put out a couple of reports throughout May, June, and early in July, looking at scenario analysis, including a guide for how central banks could use scenarios, which is really just a roadmap on how they could design and deploy them to stress test the banks and insurers that they regulate. They also released what we refer to as reference scenarios. So effectively climate scenarios that central banks and businesses can use that look at what's referred to as an orderly transition to meet the Paris climate change targets, a disorderly transition where policy action is delayed and then there's a rapid shift and an urgency to meet the targets. And also a scenario where the world doesn't meet the targets and vastly overshoots and has very severe physical weather impacts. The challenge with risk assessment on climate change is that many traditional macroeconomic models look at assessing divergence from long-run equilibria, not fundamental shifts in the economy. So the impacts of climate change can't be determined just by extrapolating from past trends. As well, central banks typically focus on a much shorter time horizon than the 20, 30, 40 plus year horizon a lot of us engaged in climate work tend to deal with. And this is something that regulators are really grappling with. And it's why there's a real growing interest in what's referred to as scenario analysis, which helps overcome some of these challenges, providing a what-if framework for organizations in exploring how risks evolve in the future. And when we look at what's happening globally at different central banks, we're seeing different models being explored. Some are broad-based tests looking at entire sectors of the economy. Others are designed to be applied to specific firms. These are often referred to as either top-down or bottom-up scenarios. This slide here is a snapshot of the various actions underway. It's by no means definitive, but you get a sense of how we're seeing a lot of movement on this issue of developing scenarios and running climate stress tests around the world. It's really important to note, for those who aren't familiar with it, that climate scenarios, they're not projections their potential forecast. They provide insight or foresight. They're meant to be iterative. And it's really about being able to see how different climate outcomes could potentially impact a business or different sectors, and you can adjust and refine as you use them. To give a bit of an example, the Bank of England, it's fairly well known around its climate stress proposal that they've released, which is looking at a time scenario. Effectively, the bank is giving the firms that it regulates a number of different climate variables, things like carbon pricing, potential sector declines or impacts on GDP, and is asking them to run them through their balance sheet. And then when they get the responses back, they compare the assumptions. So if one bank thinks that they can keep investing in a certain sector and another one doesn't, the Bank of England will give them different data to go back and test it again. And so that's sort of one approach we're seeing out there, although due to COVID, I should note that the Bank of England, they said they're delaying their climate stress test till 2021. There's some other actions on this slide, and again, as Martha said earlier, we'll be giving you the slides after, and you can look into them in more detail. For those of us in Canada, the Bank of Canada released a research paper this spring looking at different climate scenarios at a global level. For those in the Canadian finance realm, it's worth paying attention. The bank has said it intends to evaluate the direct and indirect exposure of Canadian financial institutions to climate-related risks based on available data, so that work is coming. You can also see in here that Bank of France just released a paper. They took some of the NGFS scenarios, they tailored them to the French economy. And we're also seeing a growing movement on this issue as well in the US financial system, which Jeff is going to touch on shortly. The key takeaways from all this is that if you're a financial institution in particular, trying to understand about climate scenarios, there are scenarios out there that align with, particularly that align with the Paris Agreement targets that you can use. From a regulatory perspective, we are seeing signals climate stress tests are coming, and you can see how they're being developed. So there's an opportunity to prepare now. And also, again, remembering there is no one right scenario. It's really, again, an iterative process. There's a lot of uncertainty on timing, the impact of different climate variables. The important thing when to be running them is just to get started on the work and to help identify and potentially see some of those impacts. So I'll now hand it back to Jeff, who's going to touch on the US and the EU landscape.
Thanks, Kevin. Yeah, so moving over to the US, overall, the US really hasn't been very active in terms of global coordination on climate change. That's been highlighted by their planned departure from the global Paris Agreement and their notable omission from the NGFS central bank network that Kevin just mentioned. In June, we actually saw the US Department of Labor propose an amendment to the Employee Retirement Income Security Act, or ERISA for short, which sets fiduciary responsibilities for private pension plans in the US. At this time, while interpretations have been mixed, the proposed rule change looks like it'll create additional compliance burdens and restrict pension funds' abilities to allocate assets towards funds with ESG or climate considerations. We've seen some pretty significant backlash to this as a result, with organizations like the Principles for Responsible Investment saying the DOL has mischaracterized ESG integration as an asset class rather than as a robust risk management system. The PRI is apparently urging signatories to ask DOL for an extension and is also working with influential US bodies to create significant opposition. With that said, there are some positive signs brewing out of the States. So the US Commodity Futures Trading Commission set up a climate-related market risk subcommittee, which is set to make recommendations shortly for US financial regulators, which is likely to include climate-related disclosures and other such measures that we've seen across the world. And we've also seen the pressure continue to build. In May, we saw 42 members of Congress write to the Federal Reserve, urging it to join NGFS and become an active member. We also saw the Responsible Investment Organization series release a report, which included 51 different recommendations for US financial regulators. They included the usual suspects, including mandatory climate-related disclosures and climate stress testing. And notably, all 51 recommendations from series can be adopted by financial regulators without any new legislation from Congress. We saw that series report backed up in a letter by some of the US's largest investors recently, and those included CalSTRS, New York State, and city controllers, with over $1 trillion in assets under management. In addition, we saw the SEC Investor Advisory Committee recommend that the SEC develops rules for ESG disclosures, as they say the U.S. needs to avoid becoming rule takers, as other countries like the U.S. develop standards and taxonomies. This is a pretty important point because, as we're sort of going to try to illustrate to you, the one problem with sitting back is that other regulations might begin to be imposed on the US due to just the global nature of financial markets. So to summarize, while there's lots of pressure brewing in the US, they continue to be a laggard amongst their peers. And this year's election looks like it could have pretty big implications in determining if the US continues on this trend. To understand where they could go, we're going to make a shift across the Atlantic and see what Europe's been up to. And I'm not handing off to Kevin this time, so I'm going to continue on. So moving on to Europe, we've seen some guidance come out. So European regulators are certainly leading amongst their global peers. In May, we saw the European Central Bank, which is the report on the left there, publish a guide outlining 13 different expectations for banks to identify and manage climate-related risks. The expectations include embedding climate risks into their risk management frameworks and incorporating climate risks into their internal stress tests to monitor their exposures to climate risks. The guide's currently out for consultation, and while they won't be binding regulations, they'll be used on a comply or explain basis, so the ECB can, European Central Bank, can monitor any banks that aren't following its guidelines. Continuing on the right, we look at a report from the Climate Financial Risk Forum, which was a jointly launched group by the UK's Financial Conduct Authority, the FCA, and the Bank of England's Prudential Regulatory Authority, the PRA. So they jointly launched this CFRF group, which has now launched guidance back in June for banks, insurers, and asset managers, outlining how these groups can integrate climate change into their risk management processes, perform scenario analysis, and disclose in line with the Task Force on Climate-Related Financial Disclosures, which Kevin is going to touch on a bit in more depth later. The guide supports the supervisory statement made by the Bank of England's PRA in late 2019, which outlined expectations for UK banks and insurers. Earlier this month, we saw the CEO of the PRA write a letter to all the UK banks and insurers saying that they expect them all to be reporting on their climate risk management by the end of 2021, and they cited this guidance. So, I mean, we think that these guides are worth the attention of financial institutions everywhere, as they can help understand what could be expected of them in the future. Now, moving on, we're going to take a look at the EU sustainable finance regulations. So another way to manage the systemic risk from climate change is to ensure that capital flows towards businesses and activities that are environmentally friendly. And this has been the broad goal of the EU's Action Plan on Financing Sustainable Growth, launched back in 2015. On the left is a list of regulatory initiatives the EU has been working on during this time. I'm going to focus mostly on the taxonomy regulation, which includes a taxonomy to classify green economic activities, as well as rules requiring financial products being marketed as green or sustainable to disclose their alignment with that taxonomy. And this regulation was actually just signed into law back in June and will come into effect at the end of 2021. The EU's taxonomy is really the key part of their work to prevent so-called greenwashing, which is to mislead investors about how green financial products really are. The EU wants financial markets to help them with their environmental goals. So the idea here was really to define what exactly is green and to sort of utilize financial markets to support the EU and their goals. So the taxonomy covers multiple sectors and includes activities such as manufacturing aluminum to public transportation. It's really a overarching classification system of economic activities and how to define those as green. So the key ingredient, though, is the science-based thresholds that have been set for each activity, which means that each activity must reach a specific environmental standard in order to qualify as green. As I mentioned, the taxonomy regulation also includes the requirement for green or environmentally labeled financial products to disclose their alignment with this taxonomy. And I know this is quite a confusing subject, so I'll bring your eyes to the diagram on the right. And this is an example of essentially how you would calculate the alignment of an equity fund to figure out how much it aligns with the taxonomy. So imagine for company A, it's a car manufacturer, and 12% of their revenues comes from the manufacturing of electric vehicles or hybrids, but the other 88% comes from internal combustion engines. So what this would mean is that 12% of the company's activities are going to be classified as green under the taxonomy because the manufacturing of EVs meets the scientific-based thresholds for car manufacturing, but the other 88% does not due to the internal combustion engines. So this can be done across companies in an investment portfolio and then aggregated to determine the alignment with the taxonomy. So as you'll see there, this one, the example is 10.6% taxonomy aligned that fund. To do a little bit of a side note on taxonomies, there is some concern of multiple taxonomies being developed around the world. Some of you are probably aware, so China currently has a green taxonomy for green bonds and is allegedly discussing harmonization with the EU's taxonomy that we're discussing right now. Most of you are obviously aware of the transition taxonomy, which Canada is developing. So unlike green, this transition taxonomy would be aimed at higher emitting sectors and providing them with the opportunity to qualify for financing or investment to transition their businesses. The EU hopes that theirs will become the global standard. So this is definitely going to be an interesting space to watch. And this is an example of what the SEC Advisory Committee was referring to earlier around the US not being rule takers. So it's, we can assume that probably a taxonomy will be one of the recommendations from that report. Now, finally, just to continue on with the EU action plan. So as you'll see, the EU has also been working on sustainability disclosures for financial institutions, EU standards for low carbon benchmarks, standards and labels for green bonds and retail investment products, as well as requiring investment firms to take into account their client sustainability preferences. In April, the EU Commission announced a consultation for a renewed sustainable finance strategy to decide on their next batch of regulations. So what's the key trend here? Well, I mean, the EU really is the canary in the coal mines on sustainable finance regulations. And, we think that other jurisdictions are likely going to follow similar paths in the future. So it's something for all financial institutions, as well as listed companies and private companies as well, to be aware of what they're doing. Now I'm going to hand it over to Kevin, who's going to dig into the TCFD in more detail and provide us with some examples on regulatory leadership in that space.
Great, thanks, Jeff. So I'm going to touch quickly on the trends on the ways we're seeing climate risks are expected to be disclosed. And I do want to flag, we've got a number of questions coming in. We will be getting to those shortly. So I'm just going to touch on a number of quick points here related to the issue of disclosures and climate risk. Many of you will be familiar with the Task Force on Climate-Related Financial Disclosure Framework, or TCFD, as we've been referring to it. It's really the global standard for corporate reporting on climate change. And we've seen a lot of movement at a government level related to sort of encouraging and moving that framework forward. Some of the recent ones include in the UK, their pension schemes bill would require pension funds to integrate climate change reporting in line with TCFD recommendations. New Zealand is looking at passing mandatory TCFD requirements. The Bank of England, you can see it here on this slide, they released their first TCFD aligned report recently, and they did this in part to demonstrate what they want to see from the financial institutions that they oversee. And it's quite an interesting read. For those who are interested in this space, I encourage you to take a look because they looked at the financial risks of climate change to their portfolio, sovereign corporate bond holdings. They looked at the carbon intensity of their holdings. And so it's an interesting way that a regulator in itself could be talking about climate risks. There's been other initiatives as well. Mark Carney was in the news a couple of weeks ago that in partnership with the London Stock Exchange sent a letter to a number of stock exchanges around the world asking them to commit to what's known as the UN Sustainable Stock Exchanges Initiative, which is pushing for disclosures aligned with TCFD. Here in Canada, the federal government made news back in May that they were making TCFD reporting a condition for businesses accessing a COVID emergency fund known as the Large Employer Emergency Financing Facility. For those here in Ontario, the Capital Markets Modernization Task Force just released its consultation paper. They've looked at a number of different initiatives. And they've had feedback on a bunch of stuff related to what they can be doing in Ontario's capital markets. They released their consultation paper, and one of them includes a specific recommendation around mandating disclosure of material ESG information that would be compliant with TCFD. So for those particularly interested in the Ontario context, they're taking feedback on that until September 7th. We'll see where where they come away at with that. So the key takeaways, really at a high level from this, we're starting to see a shift from voluntary guidance towards more mandatory disclosure on TCFD reporting. And particularly in Canada, we're seeing a push on TCFD, although it is a bit of a patchwork because securities are regulated more at a provincial level. But you can see where the trend is going. And I'm going to turn it over to Martha, who's going to handle some of the questions to put to Jeff and I.
Thank you so much. And we've got a couple of questions coming in. Wonderful. Thank you so much. So first question, gentlemen, is Canada a leader or a follower when it comes to performing stress tests?
Maybe I'll just have some quick thoughts on that. I would say it's probably in the middle of the pack where I would put things. The bank has said they intend to do them. They have, by all accounts, been scaling up their resources internally around climate risk. Although a number of other banks are out in front in terms of actually putting the specific scenarios and requirements that they want to run. In the Netherlands, they've done that, and of course the Bank of England I mentioned before as well. But at the same time, as Jeff mentioned in the US context, although people are pushing for it, they're yet to really be signaling they intend to do it at that level. So in that sense, the bank is ahead. I think it's also important just to acknowledge that unlike some of the other institutions in Canada, Bank of Canada doesn't directly regulate. That's with OSFI. So they would likely be the ones doing specific financial institution tests. Where the Bank of Canada can really lead is on doing the research to look at broader and more sectoral types of risks, and they have signaled that they intend to do that.
So Kevin, that's the bank stress test that you're talking about. Is that the same thing? I'm wondering if this question is also about scenario planning as a type of stress test.
Yeah, again, the Bank of Canada has published some thought pieces and research papers in recent months saying that they intend to make this a priority, and they do intend to do more work. It's worth noting that the new Bank of Canada governor, Tiff Macklem, was on the federal government's expert panel on sustainable finance, so he's very well versed in these issues. Haven't seen any particular statements from him related to sort of sustainable finance and climate just yet, although he has only just started his job during a massive economic disruption. But I expect you'll see the bank continue to find new ways to make it a priority. And certainly in recent years, we've seen the Bank of Canada has been getting more involved. They joined the NGFS. They are involved in a number of those research papers. So they are looking to scale up those efforts.
Wonderful. Another question has come in. Talk about an EU-led carbon border adjustment has increased in recent days. Is there a connection to the EU taxonomy, and do financial actors and governments elsewhere integrating this into their scenario planning?
Yeah, I'm happy to try to tackle that. I'm happy to try to tackle
that. That better be for you, Jeff. You're the one that knows the taxonomy.
I mean, I'm not, to be honest, I'm not positive about the connection between the carbon border adjustment and taxonomy. I mean, there's probably some kind of loose adjustment. I think if I were to make a connection between the two, it's likely that what the taxonomy is doing is, for a manufacturer of aluminum, let's say, if they are trying to be within the taxonomy, so i.e. meet the environmental thresholds that have been set for that specific economic activity of manufacturing aluminum, and they have to spend money to make their process environmentally cleaner, then maybe they would argue, okay, well, if a Chinese manufacturer of aluminum can now come in and undercut us on price because we're spending this money to do it, then they have an argument, and that's really, I think, what's driving a lot of the carbon border adjustment. It's sort of a tax on countries that don't necessarily have the same level of carbon pricing. But to be honest, I'm not fully aware of that and how it would integrate into scenario planning.
Well, perhaps something for us to take away and research for next time. A really interesting question, though. Thank you for that. And I'm going to take the opportunity now to kind of just move us on. So we'll move on to the next section, which is going to be about market responses, and hand it over to Kevin.
Great, thanks, Martha. So to get a sense of the market response to the demand for TCFD reporting that we talked about, it's helpful to look at a recent update that came out from the Principles for Responsible Investing, PRI, which they released earlier this month. So this year, the PRI made the TCFD's governance and strategy indicators mandatory for their signatories to report on. So in July, the PRI reported out on the results, which covered more than 2,000 investors, representing roughly 87 trillion in assets. And the main takeaway from this and with this slide is that the majority of asset owners and investment firms reporting to PRI, there has been a big uptake on TCFD. It's certainly growing, but there's still a lot of room to really enhance the level of detail in the disclosures. So you'll see here, PRI broke down the respondents across 4 categories. Almost 3/4 are what's in probably the most basic level, which is what they refer to as aware. Contrast that with the strategic category on the right. That's the highest possible ranking. It's for firms whose disclosure performed climate-related scenario analysis. They reported the results publicly. They have climate targets. They're considering short and long-term climate risks. Very few are currently at that level. And just going back to the issue of scenario analysis earlier, this is just an interesting chart that was part of the PRI's report that they put out a couple of weeks ago. So scenario analysis tends to be done, it's the more advanced TCFD signatories who are undertaking it and reporting on it. The PRI found that about 70% of their respondents were not doing scenario analysis. But of interest is of those that are, they also show which scenarios they're using here. And so you can zoom in and see there's a number there. Most of the majority ones on the left are provided by the International Energy Agency, which is very well known for releasing their scenarios. Some of the ones, and I should mention, those ones are what would be referred to as transition scenarios. So they look at things like carbon pricing and the shift and change in the mix of energy worldwide over a certain period of time. The ones in the middle, which are represented as RCP, those are physical climate scenarios they look at. And so this slide is just interesting because it gives you a sense of the types of scenarios that investors are using. And then when it comes to TCFD in Canada, we're seeing progress, but there's still a lot of gaps. It's definitely an issue that's dear to our hearts here at Mantle 314, as we recently completed a research project for CPA Canada, where we looked at 40 TSX-listed companies across multiple sectors, and we reviewed their regulatory and voluntary reporting in terms of how it aligned with the TCFD's recommendations. CPA released what's referred to as a teaser report this spring. The full report should be out later this year. And what we found was that on average, Canadian companies would only disclose an average of about 4 out of the 11 TCFD categories. There's only 1 out of the 40 reviewed, which was a Canadian utility, covered all 11. And only half disclosed on governance, which is generally considered sort of the starting point for TCFD disclosures. So the takeaway from all this of what we're seeing is that there are growing numbers of companies signing on to TCFD reporting, growing numbers of asset owners, asset managers who are taking that step to say they will disclose. But just signing on to it shouldn't be taken as a sign that it is immediately delivering comprehensive reports that have climate targets or using scenario analysis. TCFD is a journey, and it is recommended to be a number of years to build out that reporting. And what we're seeing is that even particularly in Canada, at just a governance level, there's still a lot of room for improvement when it comes to climate. And I'll hand it back over to Jeff, who can cover some of the other work that we're seeing around climate disclosures.
Thanks, Kevin. Yeah, so that was of Canada. We recently saw a report come out covering Europe, actually. So this report's it's called Falling Short, and it's by the Climate Disclosure Standards Board, which looked at the 2019 environment and the climate-related disclosures of the top 50 largest listed European companies. They used the TCFD as a framework in their research, and they found that well over 70% of firms have integrated climate change into their governance and risk management structures. Less than 15% of the companies are currently using scenario analysis to understand the resilience under different transition and physical impact scenarios. Additionally, only 30% of the firms are providing climate-related metrics and targets. Something to kind of point out here, and I wasn't really able to touch on it completely just due to time on the EU action plan, but one key part of that is actually the revision of what's called the Non-Financial Reporting Directive, the NFRD. So essentially there's current guidelines in the NFRD that require some climate disclosure, but what they've basically found is that it's not enough to fulfill the TCFD framework, and certainly under the metrics and targets category. So this is something that the EU is currently working on revising as a part of their action plan, and it's likely, I believe that the consultation is out and looking at October or something like that this year to have some revised directives. So the key takeaway here is that the report says that there's been improvements in reporting since 2018, but clearly more work is needed by companies to manage their climate risks, but also to ensure investors have the climate-related disclosures they need to assess risks and opportunities. Now, next, so to give us insight into where banks are on their journeys, there was actually a helpful report recently by Mazars, which is the global accounting firm kind of sitting just under the Big Four, and they analyzed the climate-related disclosures of 30 of the world's largest banks, albeit most of them were European, as you'll see there, finding that 37% currently address climate change within their risk management framework, and another 47 say they're in the process of doing so. So that's reflecting a pretty substantial response by banks to the regulatory expectations and guidance that we've discussed earlier. In addition, 24 of the 30 banks are currently using scenario analysis or plan to within the next 2 years. So there's some positive signs there. As further evidence of the TCFD's emergence as best practice, over 80% of the banks are currently disclosing in line with the framework or have committed to adopting it. And the problem that's been highlighted by Mazars in this report, which is general across the financial industry and into corporate reporting, is that climate-related information isn't disclosed in a comparable manner and is not always found in the mainstream reports, such as annual financial filings. Like I said, this is a general trend, and the TCFD really is just a reporting framework rather than specific standards. So we've been seeing some industry standards emerge, but this is an area that we'll have to keep watching.
So a few questions have come in. I'd like to pose to you gentlemen. How does reporting under TCFD compare to ESG reporting?
Well, I mean, yeah, so my first answer to that would be TCFD is specifically focused on climate change, when ESG is looking at environmental, social, governance. So, what you first saw in the market was, standard ESG reports where people were trying to pull really any sort of disclosures around how they're integrating ESG risks or factors into their investment or lending processes. So ESG is quite broad when TCFD tries to home in on climate itself. And TCFD is more, like I said, it's more of a framework, with climate change sort of being the key issue, rather than ESG being really a risk management system to look at environmental, social governance. So there's similarities in the sense that, you'd kind of label them as non-financial, climate and ESG. I don't know if Kevin, you have.
Actually, I'm just going to jump in because there's a sort of related question, which is, has GRI kept up with TCFD? I don't know if either of you folks have can answer that one. It's been a while since I put pen to paper on a GRI report.
Yeah, I'm not 100% sure GRI. My assumption is yes. I know SASB, which is kind of a, I guess you'd say competitor, they're nonprofits, but I know SASB, what these reporting standards are basically doing is they are trying to show how you can use the reporting standards and still use the TCFD as a framework. So, you think of the TCFD as sort of your overall reporting framework. And like I just touched on, it being a framework rather than a specific standard, that's where SASBs and GRIs can sort of emerge as to help you populate that framework, specifically around the metrics area.
Okay, Jeff, we are getting a few more questions in, but I'm going to move us along because I don't want us to run out of time. And I think you're now tackling the subject of banks and what they're up to.
Yes. Okay. So, while some level of TCFD disclosure has, what you've seen, really become table stakes for banks, the next step is to measure carbon footprints of their loans and investments to better understand their exposures to climate risks and set targets. And that's, as we kind of pointed out, that's really to help fill the reporting gaps that we just saw. We're seeing reporting of climate and governance. We're seeing reporting of climate in risk management, but to actually be disclosing the carbon emissions of a loan book, for example, is just simply not there yet. So what we've recently seen is Morgan Stanley, Danske Bank, and NatWest join the Partnership for Carbon Accounting Financials, or PCAF for short. And Citibank has also announced it is currently looking at methodologies to carbon footprint their loan book. So what PCAF does is it commits banks and investors to measure and disclose their carbon emissions of their loan books and investment portfolios, and aims to establish a standard for carbon accounting. So again, there's more sort of standards emerging, which will help people to fulfill the TCFD framework. As we mentioned, comparability of disclosures is a challenge. And again, that's where PCAF does come in and plays a role. As you'll see on the diagram on the left, being able to measure the emissions of their loans and investments, which for financial institutions would be classified as their scope 3 emissions, it helps to provide a foundation for performing scenario analysis and setting targets to reduce the emissions they are financing. And that kind of connects over to what we have listed there, around 16 German banks pledging to align with the Paris Agreement. So what they've done is they've pledged to bring their loan books and investment portfolios in line with the Paris Agreement by measuring their emissions finance and give credibility to the climate targets they're setting. So the key trend that we're seeing here, like I've said, is that leading banks are taking steps to measure the emissions they are financing, and that this is a critical step to ensure that it's a credible progress is being made to transition their businesses and achieve the goals such as Paris alignment. Now moving over to investors, and obviously there's a bit of cross-pollination between these two, but we're seeing leading investors and service providers continue to really forge ahead with providing tools to assess climate risks and transition portfolios towards a low carbon economy. Back in April, we saw the Morgan Stanley Institute for Sustainable Investing publish a framework that they've developed to assess climate risk through a 3-dimensional lens. So that's the diagram you'll see on the left. The framework encourages the systems level thinking to identify physical and transition risks across events, exposure to the event, and the vulnerability to these exposures. And this framework could certainly be used by other institutions, and Morgan Stanley has more information, which you'll be able to access through that link. We also continue to see investors collaborate on important climate-related issues. So in May, the Institutional Investors Group on Climate Change launched a report called Addressing Physical Climate Risks, Key Steps for Asset Owners and Asset Managers, which provides some practical steps investors can take to address physical risks in their portfolios, including how asset managers can engage their asset owners can engage their asset managers on the issue. As we saw with the German banks in the last section, and Kevin will touch on in a moment, investors are also trying to transition their portfolios to align with the goals of the Paris Agreement. In response, we're seeing a lot of forward-looking tools emerge to help investors measure the portfolio, their portfolio and investee companies' alignment with the Paris Agreement or other temperature pathways. Earlier this month, as you'll see there, the CDP continued this trend. They launched a temperature rating tool, and investors will basically be able to use this rating tool to then aggregate up to their own portfolio level to determine their temperature ratings. The Partnership for Carbon Accounting Financials that I just discussed on the previous slide is helping to progress carbon accounting using backward-looking data, while these forward-looking tools like the CDPs are really trying to help investors and banks to understand if the targets of companies they invest in or finance are ambitious enough. The Science-Based Target Initiative, which is led by the WWF, CDP, and the World Resource Institute, and also partially funded by PCAF, is working to develop a tool to help financial institutions set their own credible targets and measure their progress in this space. And now I'm going to hand over to Kevin, who's going to talk about specifically what asset owners are doing.
Thanks, Jeff. And sorry about that. Had some feedback there for a moment, but we're all good. We're seeing a lot of movement in the asset owner space. I'm just going to touch on all these points quickly because, again, I know we've got a number of questions coming in, and the time is of the essence here. But in terms of the asset owner space, there's a growing trend towards transitioning the investment portfolios to be net zero emissions by 2050 or aligned with the Paris Agreement. We're seeing a big push being done on this globally by the Net Zero Asset Owner Alliance, representing 27 different institutional investors, comprised of pension funds, insurance companies with about 5 trillion in assets. And they're working to drive development of more aggressive climate action through investment mandates. And they're looking at setting targets at the portfolio level for emissions. So building on some of that collaborative work, similar to some of the initiatives Jeff mentioned in the previous slide. In Canada, and there's the image of it there on the right on the slide, there was recent news about an Investing to Address Climate Change charter that was signed by 15 different Canadian universities, whereby they're committing to adopting a responsible investing framework that's aligned with PRI, measuring carbon intensity. One thing to note is that it's not a commitment necessarily to decarbonize or align with the Paris targets, although we would think that that's a likely step that university pensions and endowments could be pressured to pursue at some point. And last week also in the news, the Canada Pensions Plan Investment Board announced that they'd updated their policy on sustainable investment, stating that they want their issuers to report aligned with TCFD. And when it comes to insurance, because this is a sector where we're really seeing the challenges of forecasting climate risk based on historical patterns. And there's a lot of research in this space, but we just wanted to highlight a couple things to speak to some of the overall trends. Because really the challenge here is that the historical data that's traditionally been used to model risk is increasingly less accurate due to the multiple variables impacting climate change. There was one report out recently from First Street Foundation in the US that looked at individual properties' risk to flooding. And what they found was using some more updated climate data that the risk was potentially about twice as many properties from previous estimate about 8 million to up to about 14.5 are actually at risk of flood risk. We've also seen some reports out. Swiss Re issued one looking at how the combination of urbanization and historical data is creating a risk in the insurance industry. And the takeaway in all this is that the challenge is not so much the financial ability for insurance companies to insure these events, but rather the ability to properly assess and price risk is increasingly challenging due to the uncertainty of climate change. And just quickly on a final point, in terms of the market pressures. What shareholders have been doing around climate is really worth noting in the financial space. We saw a lot of news earlier this spring. Barclays in the UK had a resolution that committed them to aligning with the Paris Agreement, net zero emissions by 2050. Looking to do that. That was backed by 99% of shareholders. They actually put that forward following a more stringent one that had come out earlier in the year, proposing to do some limits around energy financing. JP Morgan was also in the news. There was a shareholder resolution put forward directing them to disclose how they would align with the Paris Agreement. That proposal narrowly lost at 49.6% in support. And there were also some ones that happened this spring. TD had a resolution that came forward on GHG reductions. BMO had one on fossil fuels and financing. Both of those failed to get even 20%. But what we're seeing is that there's really just a growing momentum on this. And there's an interesting chart, some data pulled together by Share Action that was in the Financial Times recently. When surveyed, asset managers outlined what were their priorities, what did they want to see on climate change related engagement. And you see that TCFD piece and the disclosure of climate related risks is what's tops. And that really speaks to, again, one of the takeaways we've had is that there is growing pressure from shareholders for companies to report in alignment with TCFD. We've seen probably more support, certainly in the US and UK, than has been expected on some of these resolutions, particularly in the banking sector. And regardless of whether or not they pass, the resolutions are putting pressure, particularly on banks, to do more than just talk about climate. There's growing pressure to show that they're supporting efforts to reduce emissions. And those that aren't, there's a growing reputational risk. So now I'll turn it back over to Martha, and hopefully we'll take a couple more questions before we have to wrap.
Thank you, Kevin and Jeff. Yes, I'm going to try and keep us to just one or two quick questions. So please keep your answers concise. So we've had an interesting question about the CDSB just announced a nature-related financial disclosures framework to help the financial sector take into account natural capital. Any thoughts on that, and do you see it having a large impact?
I can take that one.
Jeff, you go for it, because I was busy reading Joe Biden's $3 trillion climate plan piece. They both came out around the same time. I went through that one, so hopefully you went through the other. Yeah,
I mean, to be honest, I didn't actually know it was the CDSB who did it. I knew there was some tie to the UK government, but anyways, it's sort of irrelevant. So the question is,
it's about natural nature-related financial disclosure.
I mean, my initial thoughts are, I think TCFD, what came out in 2017? I think certainly within a few years, biodiversity, natural capital is a huge issue. It's massively connected to climate. I mean, the EU taxonomy I was talking about earlier, so they haven't developed it yet, but they do plan to expand that to cover biodiversity. So, there's basically already a taxonomy that's going to be built in Europe to touch on this. And, you're definitely seeing that of France for sure. I know the French investors are very, very focused on biodiversity. So I think absolutely it'll have a huge impact. And I definitely see, a few years down the road, biodiversity being a big topic with investors.
Yeah, I echo that. I certainly, in my experience, have seen a lot of interest growing in nature-based solutions to climate change. So I'm actually going to wrap us up because we're at 2:56, and I want to honor my earlier goal to not keep people past our appointed time. So I'm afraid that's all the time we had for questions. Thank you so much to everyone who submitted questions. I'd like to thank all of you for your time today. I hope you found this update on the latest in climate trends and finance worthwhile. We will be sending you a follow-up email with a copy of the webinar and, of course, the PowerPoint, and a link to a very short survey, only 5 questions. And we really appreciate your feedback, and I do hope you take the time to answer those for us. Finally, I'd like to close by thanking my colleagues, Jeff Horler and Kevin Quinlan, for sharing their expertise with us this afternoon. Many thanks, gentlemen. I learned a lot today, not the least a whole bunch of acronyms, and I'm just impressed as heck by the amount of reading that you gentlemen must be doing to stay abreast of these things. It's certainly a mini industry in reporting. On behalf of the team here at Mantle 314, I'd like to wish you a lovely Tuesday afternoon and a safe and productive week. And I'd also like you to know that we have a few other events and trainings coming up that may be of interest to you, and we welcome you to join us for those. So have a great day, and thank you again. Bye-bye.